Hello, everyone.
Yep.
Glad you could join us. It's morning for me, it's evening in Europe, and then the East Coasters are in between. Hello, everyone. Thank you so much for being here. We're going to talk about the recent paper done by the Arketa Institute, a path to post-growth pension. So, in this report, they point out that there's a fragility in our pension system, and it ultimately stems from our eternal economic growth pursuit. We have known this at least since the limits to growth, and then my 2021 report that showed that empirical data of the world actually aligns quite closely with the forecast that we saw in that bestseller from 1972. Pension funds have a long-term mindset and they control 1/3 of all the world's assets. So they have an enormous power in advocating for more resilient and growth independent economic practices. And maybe they also have a responsibility. So what is fiduciary responsibility there then? So about all these things we're going to talk about. Um, We're gonna start with Steve Rocco, Anastasia Linn, and Matt Orsak, all presenting different parts of this paper. And then we're gonna open it up for discussion, and we're looking forward very much to on your input. Okay, what are these post-growth pathways for pensions? So you can ask questions in the chat. I will be monitoring that, and then at the end we're gonna start with those. Steve will begin by outlining the risks and challenges that today's pensions face. Then Anastasia will discuss some of the solutions Arketa proposes, and Matt will tie things together at the end with an outline of where pensions, financial professionals, policymakers, and others can go from there. So, Steve, would you like to kick us off?
Yes. Thank you, Gaia. Thank you, everyone, for joining us today. It's a tricky topic, to say the least. And before we get to the pensions themselves, we need to back up a bit and understand the underlying economics. And that's the main thrust and kind of our approach to this topic. So why? Why do we have to think economics? Because every decision that you, me, the government, a pension fund makes is based on neoclassical economics. It is neoclassical economics at this form. It's changed over time, but it's the economics form that dominates our system. There's just no real big discussion around it. And this goes hand in hand with neoliberalism, which is a political and kind of economic ideology, if you will, that we all know of. It's free market capitalism, and it's all over the world. This is how decisions are made. So in any course that you take, you are going to see this diagram. This is called the circular flow diagram. And it's pretty simple. This idea is from the 1700s. It has evolved over time. And if you go one slide forward, you can see what it looks like today. This is the slide that I saw when I was in university by a Professor Samuelson, I think, Nobel Prize-winning economist. And it's more developed, obviously. But at the end, it's still the same circular flow diagram. Now, why is that important? My question is, where's the energy and materials that we need? And where's all the waste that you see in the economy and around the planet? So that's our basic neoclassical economics. If you go to the next slide, this is the ecological economics point of view. It starts at inside the middle is the same circular flow diagram, but it's surrounded also by resources and waste. The resources that we use are inputs. It could be sand, water, air. It could be rare earths, and then the wastes are mainly carbon emissions. But you could think of waste also as degradation of forests, biodiversity loss, or acidification of the oceans, et cetera, et cetera. The question then becomes, well, which one of these two competing views is correct? The next slide is the planetary boundaries framework that everyone is familiar with, or you should be familiar. And this comes from the Stockholm Resiliency Center in Stockholm, obviously, and it is the best climate science that exists. I think we can all agree. The IPCC reports are great; they're not bad, but this one has about a similar track record in terms of time. It's just more expansive. So there's a few key takeaways to get through this. We're not going to go into too much detail here. One, this is not just a carbon footprint that everyone's heard of. This is a planetary ecological footprint. All right. In 9 different key areas. The overshoot is either overuse of what the planet provides us. So this could be us using land or using the ocean, or it's waste that we're producing. This could be carbon emissions. This could be ozone depletion, et cetera, et cetera. So there's an input-output framework that makes this easier. Because both the inputs and outputs of our economies are so clear to see in this diagram, it implies that ecological economics diagram is more accurate than the one proposed by neoclassical economics, because you see that we're overusing. And from this planetary boundaries framework, our collective problem essentially is a historical overconsumption in the North, because this analysis can be done by country. And if you look at the G7 or G20, this is one level of red. And then if you look at the southern countries, primarily sub-Saharan Africa, some countries in Latin America, et cetera, they're the opposite. They're not reaching the minimum because their resource use, their economies are smaller. So if we move one, now we're going to switch from that to pensions. So first, as Guy said, pensions are 1/3 of global assets. But what we're going to say to you today applies to any pool of capital. The same logic applies. We're focused on pensions because there's savings of millions of workers around the world. So how does it work? It's pretty straightforward. The pensioners deposit the money in an account over time. There's a pension fund manager. He or she has a board of trustees. These trustees are independent, appointed. They could be workers from the company. They could be the pension fund managers themselves. This pension fund that is outsourced its management to asset managers, BlackRock, and is consulted by Cambridge and Associates. It could be many number kind of different consultants out there. The key thing to do for us, from our perspective, is that the investable universe that the pensions invest in, for the most part, is in the global north. It's 98 to 97%, and it's pretty standard, with only 2 or 3% being invested in the south. Right, that's a key thing to think about. So, if we're keeping that in mind, the next slide, we start with the problems. So, problem number one is that the pensions need to grow their assets. The reason they have to do that is because since they've given the pension management effectively over to BlackRock. BlackRock is a profit maximizing investor. It's not looking at anything else. Whatever they say on the wrapping of their funds and so forth, no, they're trying to maximize profit. In fact, even if they're saying they're investing in sustainable investments, there is recent research saying that there's no difference between traditional investing and sustainable investing. This research comes from the London School of Economics. Happy to share with anyone that doesn't believe me. So in the end, you have this problem of a growth imperative being created where the funds have to grow. And to grow, they're invested in the north. The next slide, what we believe is happening, and we are not saying anything new here, we're not the only ones, is that they underestimate risk. How is this possible? How is this? Don't they understand the planetary boundaries? Don't they have scientists? No, they're being advised by MBAs that have been trained in neoclassical economics. So what we're proposing is, again, isn't new, but what we're adding to the kind of intellectual conversation, if you want to think of it like this, is that we're pushing the boundaries to say that, hey, we're not just at risk in one sector, the oil and gas sector, which is traditionally the way people see it. It's like, no, we think that the same effects that kind of ecological breakdown we'll have across the economy is much larger than just one sector and much more harder to predict because simply the models that the pension funds, their consultants, their asset managers are using are simply faulty. They're antiquated economics and on top bad assumptions that were all created in the 90s, primarily by some, again, Nobel Peace, winning economists that now have been disproven. And this Joseph Stiglitz is a great source to look at these specific things. So when you add those two together, bad assumptions and bad old economics, you have vastly underestimated your risk. So that leads us to this picture here, which is coming from one of the IPC reports, that you have to think of pensions and any kind of pool of money intergenerationally, over time. And this does a great job of showing you someone born in the 50s, 60s, 2000s, and so forth. As they get older, you can see the color redder, and just spoiler alert, darker it gets, hotter it gets, and so forth and so on. So this does a very good job, we think, of showing you in a simple way what your kids are going to face. So there's 8 risks that we think are let's say, underestimated. One is the ecological breakdown, like what's going to happen when stuff just starts falling apart. Stranded assets originally started with the carbon tracker in London and oil and gas. We think stranded assets are going to happen across industries because it's a simple example. If the oil and gas business stops, you have truckers, for example, that were driving the gas back and forth. So that business get impacted. There's people feeding the trucker at a local restaurant. They get impacted. There's the people that built the truck. There's the clothes that the truck driver wore, et cetera, et cetera. When you start thinking this more in a systematic way, you see that the stranded assets idea crosses all sectors. Then there's the systematic financial instability that can happen. What happens when loans don't get repaid? When companies go out of business? Who's going to end up with that cost? And then that will lead to financial instability. And there's no crystal ball to anticipate it. So you can see how that can become very nasty very fast. This leads to rising costs for food, water, whatever you can imagine goes up, right? This leads to social unrest, political instability, so forth and so on and so on. The risks are much bigger than what we think and are being thought of. So at the same time that you have this kind of mispricing of risks, you have asset values that are artificially high because they're not, everyone's heard the idea of externalities, and they're not being priced. Just imagine this on a global scale, right? And you can see that you've got extremely high risk asset values that are artificially high because they're not considering the risks. Because usually you think high risk, high return. In here, it's the opposite. These risks are not normal like risks. These are risks, existential risks. And as we move further into the problems that we're going to have, you can imagine there being exogenous shocks to the system that we can't imagine. You can imagine the transition risks. If we do get it right and we transition to a kind of post-growth economy, how do we manage that? Who's going to win? Who's going to lose? Who's going to pay? And then there's this idea of these Minsky moments of something coming that we just have no idea, and it causing all sorts of problems. The last slide is kind of our one. It's not really a problem, but what we think is that the pension funds were giving an impossible mandate. They're trying to generate returns on a finite planet, at the same time trying to think long term. It's just impossible. The way they're set up today, it's not possible to manage. And so that's why the second half of the paper is what could these pension funds look like in the future? And so with that, I'll stop and we'll hand the baton off.
Thank you, Steve. Well, I've seen some people commenting in the chat. If anybody wants to ask a question just on that part, we would like to keep this very interactive. So if there are any questions right now on what Steve just said, please put it in the chat. In the meantime, there was one person who, it wasn't a question, but it was a note that they said, okay, but we need to change some things there then. And how is that going to happen? Somebody, Vlad Bunuea, I'm sorry, I hope I didn't butcher your name. Um, he said we have to, if we want to change this, we have to have some sort of uprising. He said general strikes. Otherwise, it will not change. Would you like to comment on that, Steve?
I don't think anyone has an idea how this is going to work. And that's the mature way to look at it. It's like you have to first, I think what we don't understand is how big the problem is. And so we don't react. But could there be social unrest? Absolutely. Read a history book. We've done it, every time that people get pissed off, there's a revolution. Could that happen again? I hope not. That's why the first paper we wrote, ironically, it's called By Design or By Disaster. The disaster route is social unrest, people in the streets. By design would be a planned kind of transition. And even that is complicated, but at least that's better than the disaster.
So thank you for mentioning your first paper. This is the second one. The first one goes into all the, I wouldn't say basic because it's sophisticated, but it goes into the foundational things of this. So the broader financial system and the problems with its growth dependency there. So there are a couple of questions that have come in, Steve. The first one I think is really useful. Can you just elaborate a little bit on what a Minsky moment is?
Minsky moment, it's really not a scientific idea. It's just the idea of something happening that's based on an academic by the name of Minsky that you just can't predict. And Anastasia maybe has something else to say on this one, but I think it's just that. It's just unpredictableness.
And rapid repricing of financial assets. So basically, like when we talk about a carbon bubble or something like that, it's the idea that when people realize that bubble is there, there might be something, similar to a panic where people try to sell off stocks, for instance, and it results in a crash.
It's when the market finally gets it. They understand what's going on. You can think about the housing crisis, back in 2008. It's when the markets finally got what's going on with subprime mortgages and what that means. The problem with this Minsky moment that we see coming is that it's all encompassing. And once it happens, the Asian financial crisis or the dot-com bubble or the housing crisis in 2008, yes, it was very bad. Markets crashed around the world, but everyone had confidence that, okay, after a while, things will come back. But this Minsky moment we're talking about is realizing the markets realizing, market participants realizing that there isn't going back, that there isn't a coming back to the way things used to be. So it's the Minsky moment of all Minsky moments, if you would.
Rainier Hoeneke recommends Donella Meadows' essay about intervention points. Donella Meadows was one of the authors of The Limits to Growth. So the report I mentioned earlier, over half a century ago, in which they already said, hey, they built a system dynamics model of the world. So it was broader than the financial sector. And with it, they ran scenarios and they concluded based on those scenarios that if we kept pursuing growth, so business as usual, we would see at first increased levels of well-being, but then a leveling off around now, after which a steep decline occurs. And they call that collapse. It doesn't mean the end of humanity, but a steep decline. And so this is what the Donella Meadows, based on her further work, then wrote about, okay, where can you intervene in the system? There are a couple of other interesting questions, but in the interest of time, I'm sorry, we have to move on to Anastasia, but I'll certainly keep note of these questions and we can ask them at the end. Please go ahead.
Yeah, thanks so much, Gaya. So based on the input from Steve, it's clear that pensions, as usual, are probably not fit for purpose or fit for future, as we would say. And in light of that, we have to start thinking about a new way forward. In the paper, we provide a suggestion based around a central shift in mindset. And that shift is basically moving from solving only for providing paychecks to pensioners, as we do today, and will become increasingly difficult in the future because of what Steve said. And instead, setting our goal as delivering well-being in retirement. If we're able to do this, we think that it's a significant rethink, but one that opens up new possibilities for action and value creation that are more sustainable and growth independent. Basically, we think that solving for well-being in retirement is a strong way to move towards post-growth retirement systems. Just to clarify some background, this is from our first report, just to make it clear what terms we're using. Sometimes we use degrowth and post-growth interchangeably to refer to an economic system that's different than what we have today, but there is a distinction between the two. So degrowth is the first phase. That's a rapid but intentional and democratic reduction of overconsumption and overproduction in order to bring our economy into planetary boundaries while providing for everyone's well-being needs. That's the first step. But the goal is the post-growth economy. So that's basically the steady state economy or well-being economy or economy within the donut for people that are familiar with that framework that provides for everyone's needs within the limits of what the planet can provide. That's what we want to reach, and degrowth is a process that we need in order to get there. So in the paper, when considering how pensions could become more optimized or compatible with degrowth or post-growth, we use this framework of multicapital. We also introduced that in our first paper. Basically, it's been floating around as an idea for a while, but it's just one framework we can use to structure thoughts about the kinds of value that we need in retirement, or more broadly in the economy, but in this case, retirement. So until now, we've primarily focused on financial capital savings, so that's money. But there's also manufactured capital, that's something like a house, infrastructure around that house, in the retirement example, or more broadly, it can be other production infrastructure, any kinds of like physical assets. You have social capital, which is relationships, community, and other institutions that provide value in various ways. Human capital, people's health, knowledge, and skills. And natural capital, which is the most important of all. Basically, it's the foundation for all the other forms of capital and the source of energy and materials that we use for all the things that are in the economy. Another point that's important background-wise is this concept of the pillar system. Like I said, we focus mostly on financial capital when we think of retirement savings today. And the pillar system is one way to think of or classify that financial capital. The three pillars in the middle are the most established. The first pillar is your public government pension or social security scheme. Those are often called unfunded or pay-as-you-go, which means that people that are currently working in the economy pay contributions that go more or less directly to people that are currently retired. Then you have the second pillar, which is occupational pension funds, the ones that we might have access to via our employer, where you contribute a percentage of your salary each month and your employer maybe adds on top of that. The second pillar plays a big role in many retirement systems today. And then the third pillar is sort of optional, private, additional retirement savings. Those can be invested or just sitting in a savings account. Those are typically voluntary, but they might be incentivized by tax breaks or something like that. So in 2005, though, two other aspects were added to this model, Pillar 0 and Pillar 4. Pillar 0 is not tied to age, but other kinds of poverty alleviation support that might be offered by a government. I'm thinking like food stamps in the United States. So that's something that's available to people that don't reach a certain level of income, for instance, or need other assistance. But unlike the first pillar, you don't have to be 65 or over or whatever the retirement age is in order to receive it. That's pillar 0. Then pillar 4, we'll focus a lot more on in this section because it's basically what we would consider the multi-capital pillar. When this was originally proposed, pillar 4 included family support as a means for providing care and retirement, but also policies like increasing the retirement age. And we think that the other 4 capitals can be grouped under this 4th pillar as well. And in light of that, we think that the 4th pillar would be very important in a post-growth or degrowth scenario. I'll speak a bit more about it later. It's also important to mention here that the 1st pillar is considered to be more compatible with degrowth than maybe the 2nd or 3rd pillar would be. There's been a few academic papers published so far by, for instance, Laura Wyman or Tim Jackson and team that we cite in our report that show that pay-as-you-go schemes could be reconciled with degrowth, most likely by increasing worker contributions. That's a political challenge rather than a technical one, but one that we think could be desirable if included in a broader degrowth policy package, which, thanks to research from colleagues of ours at the London School of Economics and the Post-Growth Transformation Lab, we know to be fairly popular. I can share that link later. It's also important to look at the new foundation that's added to this pillar, which is natural capital. Basically, if we continue depleting natural capital and surpassing planetary boundaries, like Steve said, the foundation will be eroded and all of those pillars will fall down. So this is an important change in how we think about pensions in a degrowth or post-growth context. These images are kind of symbolic, but they sort of show the difference of importance and reliance on different forms of capital as we might see it in a post-growth future versus today. As you can see, the pillars 0 through 3, which represent financial capital, would likely be smaller. That could be because of the losses that Steve described. It could also be because of just broader like cultural changes or policy changes related to degrowth. But we think that whether it comes by disaster or design, it's a good idea to focus on building these other forms of capital that more directly fill our needs. So it doesn't mean that financial capital is becoming completely unimportant, but basically we can think more consciously about how we're building social capital, so how our communities might be able to provide back to us when we're older and maybe need more care, or how our health, like investing in our health, can reduce our healthcare costs, for instance. So on a more individual level, if we look at the possibilities for action, we could see something in line with this approach being, for example, reducing your working hours, which would reduce financial capital assets. You'd maybe save less in your retirement account, but you would have more time to invest in community, social capital, so your relationships, spending more time on that. You'd also have more resources to commit to, say, local environmental activism or supporting community-supported agriculture or other biodiversity-related initiatives, which would be building natural capital and reducing the risk in the overall system, as well as providing for the resilience in your community. In this model, you might also decide that it's worthwhile to invest in community-owned solar projects. So that's investing time and money in building infrastructure that you can benefit from in older age. And like I touched on before, the topic of health, if you're not working as much, if you reduce your stress, you can have better health outcomes. Also, say more time to exercise, which you can then benefit from when you have lower healthcare costs in retirement. So this is kind of an example of the mindset that we're talking about in this paper from an individual perspective. And Matt will talk a bit more about the opportunities for institutions and pension funds related to that. So in the paper, we have this sort of pyramid model where pensions today are top heavy with maybe not over investment, but a lot of investment in financial capital and very little in natural capital or the other forms. And we think that in line with a degrowth transition, the contributions of individuals, institutions, including pension funds and governments, could instead move towards this model, which would be a much more stable basis for a retirement system. There, we recognize that natural capital is the foundation for all of the other forms of value, and we invest in it in line with that. So that means pursuing regeneration efforts and bolstering other forms of natural infrastructure that help human life on Earth remain possible. We'd also reorient our economies around well-being, providing well-being, which would boost human capital, and people that have better health, more time, can invest more in communities. So that's social capital. Those communities could become more resilient, even in the face of the large shocks that are coming. Even if we take the best degrowth path, it's still going to be a bit harder than it was in decades past to live on this planet. So that's a very important. Manufactured capital is still important. Of course, there's certain material things that we need, but financial capital is no longer as central. It's not the sole way that we're providing for ourselves in retirement or before. It might still have a role to play, but if all of those other capitals are more filled up, it's less likely to be as important. It's also important to note that if natural capital collapses, as we mentioned before, money is not going to be worth very much anyway. So just to recap, we think that a multi-capital approach can help us provide for retirement in more holistic and resilient ways. We already use different forms of capital and rely on these multi-capital forms of value throughout our lives, but being more aware of that can help us build more resilient pension savings. Like I mentioned, individuals can already start applying this mindset on top of their pension as usual financial capital pension. And yeah, Matt will talk a bit more about what institutions can do later on. And then I think it's worth noting that political engagement is a relevant form of investment in this model, because if we're able to realize this just transition to an economy that can provide for everyone's needs within planetary boundaries, it's probably one of the safest bets that we can make for our well-being in retirement. So with that, I'll be happy to take your questions. Thanks.
Thank you, Anastasia. I actually think you mentioned several questions that we didn't get to earlier. So, for example, somebody during Steve's presentation said, can you speak of broader fiduciary responsibility and just talk about livability for pensioners? It's not just money in the pocket. I think you just answered that. There were a couple of questions about the pillars that you covered. So one question was, what would it take to convince, he said, the empire, but the powers that be, to modify the first pillar in the US to eliminate Roosevelt's compromise to exempt non-labor income and wealth from FICA contributions and limit the labor income to a ridiculously low annual maximum? First of all, I guess we should say, do you agree with that? Is that something that should change? And then the question is, if yes, how would we go about that?
Yeah. So indeed, the reforms to the first pillar in the US and beyond would represent a pretty significant change. we didn't include it in this presentation, but in the paper we talk about how one of the biggest concerns that we are aware of collectively is demographic aging, and the ways that that affects Pillar 1 plans, in that there are going to be less, and in the global north countries that are aging, on average, there's going to be less and less people actively working in the economy that can pay for the contributions, give to older people. Older people will be a broader, or more numerous population. So that's where the conversation has mostly focused so far. So in terms of the political change that would be needed, we think that it could be pursued by itself, but the sort of reforms that we're proposing would make more sense as part of a broader degrowth policy package. And then we get into the discussion of how can we make that politically desirable, which is the work that we and many other people in the new economy space are trying to do. So it would, Matt will get into some more of the cultural changes and other aspects that would be relevant for making that more viable. But I'll just say quickly that it would be a broader shift towards thinking of my individual pension savings and risks, and how I'm going to provide for myself in retirement, and instead thinking, okay, in the face of climate change, in the face of all these other things, I'm not sure what's going to happen. I think it's better that we make sure that we take care of everyone, including me. And that's a cultural shift that would allow for those kind of political policies to become more widespread in terms of desirability. Yeah.
Yep. There was a question earlier where someone asked, can you comment on the difference between productive investment versus speculative investment, and how these feature into the pension fund's portfolio? I think you answered that as well by saying, oh, well, we're going to look at different kind of capital. It's not just, it's going to be much less financial. And these other capitals are much more productive. They actually improve our livelihoods, etc.
Yes.
Do you want to add something to that?
I can say a little bit more about it. So we do talk about it more in the paper, how financial capital, and particularly the financial capital invested by pension funds specifically, could change. That's also touched upon in our first paper. And basically the productive term versus speculative, in the financial world, we use the kind of funny term, the real economy, to refer to what we might consider productive forms of investment, versus speculative, which would be, say, betting against certain forms of economic activity, or investing in derivatives or things like that, which are not like giving a loan to a local business so that it can provide fresh food for the people that are working there, or something like that, which we would consider more productive. So there's definitely more on that in the paper, and Steve can add something.
There's no, you need regulated terms for these things, and there isn't. What's speculative to some could be a great investment for another. There's no rules.
Yeah.
These are just terms, the terminologies that we use, but there's nothing when you sit looking at the markets, there's no, what's good, what's bad. There's no morality there. The lens is just returns. Is it good? Yeah. Is it high returns? Okay, good. And there's no other way that we do it today.
And I might add to that in a degrowth transition, part of what we would be doing is deciding about the kinds of economic activity that we think are valuable, that we think provide for well-being needs, and that are important. And so that is a broader societal discussion, and one that we think we should have, and that shouldn't be excluded from the political realm. Which is possible today because we just pursue economic growth as a inherent good, which we don't think it is. So, yeah.
All right, thank you. So there was another question that talked about limitarianism, which is a term that philosopher Ingrid Robijns from the Netherlands. I'm Dutch too, that's why I can pronounce it so well. Wrote about, and she has put forward. She makes very clear that the limit ultimately is a political discussion and differs per country, but she put out a general figure of $10 million there. So this goes, of course, to the question of inequality, which I believe should always be touched upon, no matter as soon as you talk about any kind of financial things, because that is also what this growth does. It grows the inequalities. My beef with the World Economic Forum, for example, is that they talk about eradicating poverty without addressing inequality. They just shun from the whole aspect. And nobody knows why, I guess. So what do you think that, Anastasia, that if we have, say, a wealth cap at $10 million, how would that change how we design pillar 1, 2, and 3?
Yeah, so it's important to note that retirement savings, like other aspects of the economy, well, they basically reflect inequalities that are present already in the economy. So if you are, say, forced or obliged to do unpaid care labor because, say, your parents don't have enough retirement savings and you need to take care of them, you're able to work less in the paid economy and contribute less to your pension, and then you have reduced savings. So the differences in retirement savings basically reflect how much money people are making to begin with. It's important to note, though, that we don't know about that in terms of other forms of capital. Like in some cases, people might be very low in financial capital, but very high in social capital. That's not always the case because, say, you're working 3 jobs, you don't have much time to build community outside of that. So yeah, those inequalities are definitely reflected in the pension system we see today, particularly because it largely has this very individualistic focus. That being said, though, we could imagine Pillar 1 becoming much more progressive in terms of contributions. So that would be similar to, say, like a progressive wealth tax, where you have like increasing percentages of contributions coming from people that make relatively more money. And on a, say, country by country basis, you could decide what you think is appropriate for that, but it would be a means for increasing equality, because people could get similar pension returns out of that first pillar, but pay in different amounts so that it's like more equalizing. I think there is research that in retirement, there might be some reduction in income inequality, but yeah, not quite sure about that. Yeah, and then Pillar 2, Pillar 2 largely reflects the difference that I described before, where if you need to take time out of the paid economy for caring for children or others, or you reduce your working hours for various reasons, your Pillar 2 will be smaller, but you may or may not have other forms of capital that are compensating for that. So we definitely see the opportunity for decreasing inequality and the reasons that would be important. And we think that some of these pension ideas could help.
Great. All right. We have time for one more question before we move on to Matt. I think this is a really important distinction to make. Andrea asks, well, can you elaborate on, what you are proposing and talking about in this paper, and the previous one as well, and how that is different, categorically different than the sustainable finance ESG frameworks that we've been seeing? And she adds, that is dying due to the lack of credibility, false claims, and greenwashing.
Yeah, thank you for that question. Indeed, that is a key topic in our first paper. So yeah, people that are interested can reference that. But the short version is basically the techniques that we currently, or strategies that currently fall under this term of sustainable finance, are far from what we would consider sustainable from a degrowth or ecological economics perspective. As Steve mentioned at the beginning, the investable universe that they're working with is not very sustainable to begin with if you're talking about public markets. And even in terms of private markets, you'd see opportunities for inequality and basically similar behavior to investors that are not so-called sustainable investors or impact investors even. So when I used to work at CSP, there was some research about that and this like warm glow effect among impact investors, and the idea that even committed impact investors who are, say, at the most, or at least theoretically, at the more sustainable side of the spectrum of capital, that they are still usually unwilling to trade lower returns for higher impact, whether that's like 10x reduction of CO2, as was used in that paper, or other forms of multi-capital returns or impact returns. So basically, the paper that Steve mentioned earlier from, I think it's Tom Gosling and Alex Edmonds et al., basically admits that it's almost indistinguishable, the behavior of sustainable investors and traditional investors on the ground, because they have similar decision rules and are seeking market rate returns, which are inherently extractive and unsustainable from our perspective.
So thank you.
Just to jump in for a second, whoever asked this question, I'm happy to talk to you for 3 or 4 hours on this topic, as probably any of us are. Just a little background, and we have time. I'll just be quick. My first assignment in my previous job was to be part of the team. I was just one of thousands who created the PRI Principles of Responsible Investment back in 2005. And so I've had the unique perspective of seeing it kind of that world from creation till what it is now. And what Anastasia said and what Steve talked about before is exactly right, is that there isn't a sustainable universe, a truly sustainable universe of investments that we're dealing with here. Your cupboard would be bare, if you're looking for those sustainable investments. And so what we're trying to talk about is, we started off with, this is just physics to chemistry is in charge, and the planetary boundaries are kind of our balance sheet. It's not that, and sustainability in ESG over the years has become co-opted some, and it's become more marketing than it is actual substance in many cases. But again, we're happy to have that conversation if people want to follow up. That's a rich, vein of discussion.
All right, Matt, do not mute yourself again, because you're up next. We've had Steve lay out what the problems and the risks are from the current system. And then we just heard Anastasia talk about the solutions, how it can be different. And then where are we going from here, Matt? What are the next steps? Please elaborate.
Sure. Next slide, please. In our first paper, Budgets After Design, last year, and in this paper as well, we talk about culture, and that what we're talking about is a huge cultural change for people, for individuals, for institutions, for the law, for our whole culture. And so we think we would be remiss if we didn't address those things, because if you just cut out the third part of that paper and the third part of this paper, it's pretty radical what we're talking about to most people who came up in finance and economics, sustainability, which is the world I've come up through. And so we need to acknowledge, there's huge cultural changes we're asking for people. And in the paper, we break down, what are some of the legal barriers and the opportunities to change that, institutional problems, institutional barriers, and institutional changes that need to happen. But in the end of the day, they're all cultural changes. And so we'll walk through a couple of them here. And of course, ask your questions of Gaya. Put those in the chat, and we'll get to those after I speak. Starting off, legal barriers. I mean, I remember writing the paper, and every time, and Anastasia had the same experience, and Steve had the same experience. We're writing the paper and thinking kind of off to the side, well, that's not legal, that's not possible. We'll be challenged. This will be challenged legally. I'm sure many people reading the paper would. The first barrier to talk about is, the legal limitations and the prioritization of financial capital. And that gets back to that great image of the pyramid that is top heavy with financial capital, as it is now, and social capital, human capital, and natural capital are neglected. And so that's the problem that we see, is that our pension systems focus exclusively, nearly exclusively, on financial capital. And the bottom of that pyramid is structurally unsound and will collapse in the near future, depending on what we do. A barrier, the fear of being the first mover. Of course, this is familiar to everyone. We all know what the problems are, but who's going to be the first one to step up and say, "Well, I want, to have legislation that changes what fiduciary duty is." That's not going to be a very popular opinion, but we think those things are necessary. And then this isn't what pensions were designed for. We go through a lot of it's not in this presentation, but we go through kind of the history of how we got here in pensions in the paper as well. And just like any huge monolithic institution that's evolved over time, there wasn't really a plan about how pensions were going to evolve over, the 100 years or so they've been around in their current form. And so, a lot of what happened was ad hoc. In the US, it's going to be different than what happened in the UK and different than what happened in the Netherlands and so on. So the pensions, started off to be designed just to, help people not have have mass poverty in old age. And over time, things got added onto that, different things changed. And in the past 20, 30 years, for example, the move from defined benefit to defined contribution schemes, we focus more and more just on, the metaphor I use is accumulating more and more, a bigger pot of gold at the end of our lives, and that will take care of everything. And of course, it won't. We need that human capital, that social capital, that natural capital to be taken care of. And so pensions have evolved to be almost exclusively focusing on financial capital. And they weren't really designed that way. They evolved that way. So we want to take a step back and say, this isn't working. This isn't what we need pensions to be doing in the long term. And what do we do about that? We have some things we suggest in the paper, but we want to be going out into the world, talking to pension funds, talking to endowments, and talking to you and talking to policymakers about what are some of the things we can do. And I'll talk about some of those as we go forward. Next slide, please. The institutional barriers, lack of investable projects. The opportunity has changed expectations and value of multi-capital returns. Gets right back to what we're talking about. Our overemphasis on financial capital and pensions, and this gets back to the question or the statement of, pensions were given an impossible mandate to grow, but that growth is destroying our environment, and causing us to get into overshoot and causing a breakdown of our society and eventually of our civilization. But we can't consider that. And so we have to step back and change our expectations of, we understand the equity returns aren't going to be what they were if we have less growth, and accept that and say, that is going to cause other things, other parts of our society, and pensions could be part of that, to step up and take care of that human capital, that social capital, and that natural capital. And we'll talk about some of the things that could do. That could be pensions directly investing in the commons, for example, or directly investing in things that they haven't invested in before. And that gets back to the legal problem of, well, that's not their fiduciary duty. So we need to evolve and address those legal issues of, well, how can pensions do things differently than they're doing now? Because now they're in this legal bind of having to provide further returns, which is just making things worse. The barrier, current incentive structures reward only financial returns. Of course, you change the incentives as much as you can. Some pensions and some asset managers do a bit more of value, or aligning incentives with environmental issues or social issues, but it's still very rare and very small. And so we need to incentivize our pension professionals and our investment professionals more on how do they provide for that social, human, and natural capital. Collective blind spots. And this whole paper is about challenging assumptions. Like I said, reading those first two parts of the report does seem pretty radical for most people, because that's the story we've told ourselves about how the world works and how finance needs to work. And we need to challenge that story, because that story is getting us into a bad place. It's already gotten to us into a bad place. And we need to reassess that story and tell a better story that gets us to a better place. A mismatch between pension offers and beneficiary needs. This gets into, pensions finding ways to better provide for that natural capital, social capital, and human capital. And of course, lack of skills, the opportunity is build or hire new competencies. I was fortunate or unfortunate enough to go through the CFA program. Depends on your perspective of CFA in the financial world, but I find it most helpful because it taught me so much about how the financial world works, and that's what I wanted to know. But at a lot of pension funds, a lot of financial firms, there isn't the other disciplines involved. Steve goes back to, what Steve was talking about, how the risks are so misunderstood. How could that be? Well, the incentive structures, you know, reward those risks for not being fully understood. Because if they were fully understood and we stepped back from the precipice, if you will, investing, pushing for growth, returns would be less. Incentives would, those incentive packages would be much less. And so we need to build those other skills in the sciences, and into these communities, into these trustee boards, so they understand more about what's going on. And we would argue that includes more employee participation, whether that's union participation or individual participation in these decisions. Because the people give the pensions power, but they don't have much power over what the pensions do. And so we think that should be part of it as well. Next slide, please. And cultural barriers, I'm here in America. Anastasia and Steve are all Americans, but they're smart enough to get out of America and live in Europe now. We questioned Gaya. She's European, but she came here for some reason. But it's the rugged individualism of America is, I'm joking about. And I don't hate America. I love America. It's wonderful. I love the rugged individualism. I think that's a great part of being an American, the myth and the story of America. But the only thing that makes, to steal a line from Carl Sagan, the only thing that makes it all worthwhile is each other. And we all crave acceptance and belonging to something bigger than ourselves. And if we're all individual dragons sitting on a ball of gold at the end of our lives, we failed. And that's not where we need to be. And so we need to, and it's interesting. There's a great book it's a huge doorstop of a book, The Dawn of Everything, that I read a couple of years ago. And it's about, and the guys they're not financial folks, they're anthropologists. And they look at human civilization and how it evolved. And this idea of individualism in societies is very, very new in human history. And that the point of societies is to value the individual above the whole. And I think there's, of course, a balance to that. I love the rugged individualism of America, but it goes too far sometimes. And we need to get back to that idea of providing for everyone and everyone living within planetary boundaries, because the other way we're doing it now has got us into this mess. Well, I'll stop preaching and go on to the next one. And, a lack of courage, and the opportunity is here as leadership. Yeah, we've gotten to where we are because our incentive structures, people do what they're incentivized to do. Cultures incentivize cultures in what's acceptable and what's not acceptable. Show us what the incentives are acceptable and aren't acceptable. And leadership steps forward and says, no, we're not going to do that anymore. We can't do it that way anymore. And so we've seen, fortunately, a lack of leadership in a lot of areas to get to the point where we are now. and to change things as we think they need to be changed. And I think a lot of people on this call believe they need to be changed. We need leadership, and that doesn't, come from one inspirational leader. I don't believe. I think that comes from the ground up, from the community, building from the community level. And so that's a lot of what our project is helping to do that and helping bring people together, community by community to do that. So we invite folks to be part of that leadership, if they wish. Next slide, please. And this just reemphasizes this is this is about our culture. This is about the stories we tell ourselves about who we are and what we want, and what our pensions, in this case, need to be providing. Whether it's individual changes, institutional barriers, legal barriers, they're all cultural barriers. Next slide, please. This came from our first paper. We thought it was important to put in because this is from a gentleman named James Clear, the layers of behavioral change. What we're asking for and what we're talking about are huge changes to the way people see themselves. And it gets down to people's identity. The outcomes we want depend on the processes we go through, and that's how we define ourselves. And so if we want an outcome of a more livable planet, we have to change the processes and change our identity. We're all born into this, global religion of capitalism. It's not a good or bad, it just is. But it's not serving us the way it needs to be. And so that is a threat to a lot of people's identity. And we get that because we're asking for a big cultural change. And we want people to acknowledge that, and then come with us on this journey. Next slide, please. So in conclusion, chasing growth, not surprising from a place called Arketa Institute for Postgrad Finance. Chasing that growth is the problem. We advocate for moving to a post-growth economic system, a well-being economy, and that needs to be reflected in our pension system. We thought this was our first paper after our introductory paper because pensions control 2/3 of the assets in the world. So they have a huge amount of power, and a huge amount of responsibility. Again, as Steve said, poor risk analysis from the neoclassical economics side of things. We need more science-based and honest and pragmatic risk analysis. And as the pyramid in this presentation so well shows, there's too much focus on financial capital, and that makes the whole system structurally unsound. Next slide, please. So the next steps, what we're doing at Arketa, and we invite you to help us with if you wish, is to bring the missions to the pension industry. We already have some people that we're talking to in the pension industry, but if you know people you think we should be talking to, or you're at a pension fund and you want to talk more about this, please let us know. Bother us. We'd love to be bothered about that. We'll continue to do this work. We already have a couple other projects lined up. We're also going to be out speaking on these issues in the next couple of months. We want to talk to other institutional investors and asset managers. And again, if you can facilitate that or know, people you think we should talk to, let us know. Build our network and build this movement. Again, it's focusing on communities, bringing communities together. If you know anyone or would like to help us financially, you can find that stuff on our websites or talk to us about that. And I was thinking when I was looking at what to say, that all of this can seem very daunting. What we're talking about is a radical change to a lot of the ways finance works. And then I started thinking about, that change can be overwhelming to people. But I stepped back and I saw there's a number of things that have happened just in the last couple of months that show that people are always working on this and trying to find better ways to do things. And I just want to highlight some. I'll put them in I copied them. I'll paste them in the chat. There's just a couple different things. There's a report that came out, the MAPS report on post-growth futures report from a group out of Hungary. And it's a fantastic report. It's a little long, but I advise you to look at it. And what they do is they're futurists, and they look at a future world and what would need to happen for us to get to a post-growth world within planetary boundaries. And they lay out policies and different steps that could do that. And they also look at different, not desirable futures that we could have. That's the MAPS project in Europe. It's funded by the European Union. The name of it is Post-Growth Futures Report. Then there was David Boyer and Natasha Hulst came out with a paper focusing on bioregionalism, relationalized finance for generative living in bioregions. And that's thinking about organizing our decision making around bioregions. You start with protecting your watershed, protecting your forest, protecting your river, protecting your ocean, and then you move on beyond that to whatever markets or economy. We have it backwards now. We want to provide returns, and if that harms the river, well, okay, we'll deal with that later. If that harms the forest, okay, we'll deal with that later, and we need to switch that around. And another one I saw was the folks over it used to be the Post Growth Guide, but now it's called the House of Small, came out with a paper. They do great work. They've been doing it for years. What degrowth looks like for degrowth companies, because that's another question. Is like, what does this look like in practice? And that's in the links as well. And they go through 10 companies and that they focus on the well-being of their economy, their society, and their workers, and they put that in front of growth. And the last one I saw, and all this has happened in the last couple of months, is Scotland is now in the process of making community well-being the law in Scotland, and they want to create plans to keep wealth within Scotland instead of it going out and dispersed to share owners around the world. So that's just to say there's just four small examples of people who've been working on this stuff for years. There's a lot of those people. There's millions of those people out there. We're just some of them. If it's not us you're reaching out to, reach out to those folks because you can help build this movement. I'll stop there, and we have about 20 minutes for more Q&A. I just want to say that guys got to go at the top of the hour. Anastasia, myself, and Steve will stick around if people want to talk to us afterwards for a little bit. So we'll move to Q&A.
Yeah, thank you, Matt. I want to stay on this emotional aspect for just a few minutes. One of the recurring themes that I got from the chat was really this notion of what you also addressed, the fear. And I recognize that too. I started my career in finance in Europe. I worked at the Dutch central bank for many years. And in my opinion, most people are aware. The analytical, the numbers part of this, they see it, they see the writings on the wall, but they also feel very stuck in the system and feel like they can't change it because this growth imperative is so very clearly in their daily lives.
Yeah.
So how do you I remember so Matt and I actually met in person about a year ago, I think, a little less, at the Sustainable Finance Summit in Montreal, Canada. And when I gave a presentation there, I ended also with a note about, okay, what can you do? I addressed the fear and I said, well, also, I think you should stand prepared because I know that that for many people, it goes too far to act now. But I also think things are changing already and people are
Yeah.
more and more connecting with each other on this. And do you think that this kind of tipping point can happen in the financial system and within pension funds?
Uh, yes. I mean, it will happen by disaster design, you know, um, and we'd rather do it by design or design it as much as we can. Um, and that's part of one of the reasons we started doing this is, we see. I come from a finance and sustainability world, and Steve and I are, old white guys in our 50s. We've been doing this for a long time. And we have similar stories in that we didn't really come across this post-growth ecological economics world until very late in our careers. And I was in the sustainability world researching and all this type of stuff all the time. And I didn't come across it until I was in my mid to late 40s. And which makes me mad in retrospect that I didn't know about these things because I would have wanted to do more and done different things with my career and my life before then. And so I love the saying that, the best time to plant a tree is 30 years ago. But if you didn't plant it 30 years ago, plant it today. And so that's what we're doing. A lot of these issues, that metaphorical tree should have been planted 30 years ago. We should have been dealing with these things 30 years ago, but we haven't. And we see, and there's the resources I talked about a minute ago have all come out in the last 3 months. I think 10 years ago, none of that, or very little of that was being done. Very little of that was being talked about. There's a couple of great reports that came out early last year. One of them was by Whole Loop Labs and the London School of Economics, and they surveyed folks in the UK, business people in the UK, and all of them generally supported degrowth policies. They didn't name them degrowth policies, but they were afraid that they wouldn't be able to do them, and they didn't think they knew that they were alone in thinking that way. And about 70-80% of them all felt the same. That 70-80% of these people thought they were alone, knew they were alone in thinking that way. And I can't do this because there's no solidarity in this. And so the long way to answer the question is yes, this is possible. It takes leadership. It takes people demanding it from the pension side of things, from the pension trustee side of thing, from the people working at those places. And what we're trying to do is normalize these conversations, give people permission to challenge the system and build a better one. The old Buckminster Fuller quote of, don't try to save the current system, build a better one. And so that's what we're trying to help do. So yes, we think we can build a better one, but it's going to take a lot of people to push that forward.
Yeah,
That's a
maybe
great.
I can say something about fear from the first part of that question. As Matt was touching on with the hidden business majority stuff, the working hypothesis that I use is coming from Renee Lertzman's work. I can put the link later, but her first book based on her PhD thesis was called Environmental Melancholia, and basically proposes the idea that even people that seem like they don't care about the environment because they're not politically involved or maybe voting against those interests or something, they do care. They have positive memories of, say, fishing with their dad in the river near their house or various things. Like, we all depend on natural capital and have at least some interactions with it. And basically, in her research, which was based on in-depth interviews with members of the community that didn't seem to be involved in environmental activities, is that it's not that people don't care or even that they don't know the facts, but that they care so much that they have to protect themselves from overwhelm. And I think all of us know how to deal with that. Like, we all have to deal unconsciously mostly, but also sometimes consciously with extremely overwhelming things, especially when we get into the kinds of like systemic risks that we're talking about here. And there are ways in which it seems easier to just avoid it and try to keep what is normal secure. But by doing that, we're actually eroding what is normal or what we want to have, which is safety. So we talk about that in the pension paper and how a big aspect of retirement saving is about security. But like we said, we think that ignoring the signs, ignoring the planetary boundaries, and pretending everything is fine is not a way to provide genuine security. Ultimately, we need to go through this process where we can act in line with those warnings and reach a point where we're doing the scary thing, where we're acknowledging the addiction or moving beyond the denial stage of grief, really feeling it, which can be hard, but hopefully doing so with the support of others and community, and then moving towards action together.
And I just want to really emphasize what Anastasia said, and Gaya was on LinkedIn the other day, and she got an email from someone who was reaching out to her because she felt scared and overwhelmed. And just to tell people you are not alone. There are so many people that are with you on this, and we feel just as scared as you do. We've just maybe been scared longer. That's all. And there's a huge community out there that wants to solve. I don't know if these problems can be solved, but deal with these problems and get on the other side. The only way, there's no way around. We have to go through it, but let's go through it together. So if you need your hand held, we're there to hold your hand, and we need our hands held as well. So there's a huge community that we're just a small part of trying to build. And so join us and join anyone who's on that journey with you.
Thank you, Matt. I think it was very important that we lingered a little bit on that emotional aspect, because as you mentioned, that Loop Labs report as well, it made people feel isolated. They thought they had these values, but they didn't see the changes that would bring them more in alignment with that. So they just assumed that they were in the minority, and actually we are the majority, which does bring us to the next question of Darius in the chat. So why is it not happening if it's what the majority wants? Which forces exist that go in the opposition of this? And after that, we will talk about stock markets. Yes.
It is happening. It's probably not happening to the speed we would like, but it is happening, and that gets to the tipping point of enough people understanding what the problems are, knowing that they're not alone, that other people feel the same way. And there's studies on this I forget the exact numbers, but it's like once 10% of a population really believes in something and will change the way they think about it, and I've seen numbers between 10 and 20 and 25. And that gets back to things like slavery and any huge cultural change throughout history. But like that whole Loops Labs report said, and there's many others like it, that many people feel isolated and alone. And people are seeing more and more that the system that we have doesn't serve them or will not serve them in the future. I remember when I graduated from university years and years ago, the world was a pretty optimistic place. There was much more opportunity, and I could see a bright future ahead. The generation that's coming out of university now knows that is not true. Knows that is not a possibility, and they know what's going on. And so, again, it gets back to by disaster design. If we stay on this path, it will collapse. It will crumble, and some things will collapse anyway. But it's up to us to build that better system, and the resources I just put in the chat are just ones one person has come across in the past 3 months. And I would encourage people to find those kind of organizations, find those kind of things, whether it's doing things in your bioregion, doing things locally, politically, to build resilience in the future, because that's what we're going to need. Is those things, they are changing and they are happening. It's like the old quote about going bankrupt. It's like everything is fine and nothing changes, and then everything changes all at once. That's what the historians will say 100 years from now, if there are historians 100 years from now. But living through it, we moved from feudalism to capitalism on a very slow time frame that took centuries. This isn't going to happen tomorrow or next week, but things are changing. I would encourage people not to get dispirited about things not changing fast enough. And that gets back to community and joining that community and finding that solidarity to help you, because we all need that. We all have days where things just seem too overwhelming, but things like this, at least for me, help me keep going.
Steve, do you want to add something about the forces that may exist in opposition to this movement? Okay. I think not, maybe.
Oh, sorry. No, yeah, sorry, I was muted. If you look at history, the powerful never give up power. They cling to power. It's So why is that going to be different anytime soon? And today inequality, which we didn't really talk about today too much. Inequality is a massive problem. And that inequality, creates so much unbalance in power. And you can see this in the United States. There's no even point in discussing it. It's just out of control. So how do you get power back from those people? History doesn't paint a pretty picture because they usually don't just give it back to you, right? But so that's why the pensions, I think, could be an interesting route, because the pensions is the people's money. And if the pensioners themselves, I've had some conversations with family members in California, and I told them your pensions are at risk. And they said, no, our pension fund managers know what they're doing. And I go, are you sure? So could that be a way to get popular support to do this? If not, I just, again, history points a very troublesome picture of what could happen. The power never is just given because people said, okay, here, you can have it. It's usually taken and by force, which is by disaster scenario.
Right. Okay, just to throw something in to add to that, a great book on this is I'm giving, and I realize I'm giving people a lot of homework, but a great book on this is End Times, that happy title, End Times by Peter Turchin, that came out a couple of years ago, and he details how throughout history, this inequality, reaches a place where it's untenable anymore, and then it collapses, whether it's the French Revolution or whatever it is. And interestingly, one of the times that didn't happen was the Depression in the U.S., where I'm simplifying a bit, where Roosevelt said to the elites, "Look, you can come and deal with me, or you can deal with the people with the pitchforks," and that's in the streets, and and they chose to deal with him, and you had the New Deal and things like that. Now, it's a more complicated history than that, but that's generally, one time where the elites got together and said, okay, this is very bad. This is going to end badly for us. Let's do something about this. And so we hope that we reach that kind of conclusion rather than the disaster one.
Yeah, maybe I can just provide one other historical example. So regarding like the development of welfare states in Northern and Western Europe, I think particularly in Northern Europe, you basically had like very broad coalitions of farmers, workers, unions, like the majority of the people in the economy pushing for welfare related things, but also proportional representation. So this is maybe getting a bit deep, but the form of voting where seats are assigned based on how many, like what percentage of people voted for that. That's what we have in Europe. In the United States, it's first past the post, which means, we only have two political parties. Anyway, basically that was exactly the situation as Steve and Matt were describing, where elites saw that either they could move towards this proportional representation system and maybe have one seat out of 5, or they could keep losing every single time, because in a democracy where people are voting like one person, one vote, at least theoretically, they wouldn't have a chance. So that was based on a broader coalition of people across the economy that realized that their interests were aligned. And we think the pension thing could align with that. Yeah, thanks, Gaya.
And Anastasia, now that I have you, you mentioned pay as you go. That would be degrowth aligned. How about the stock market? Several people have been asking about that. Should it just be a shrinking proportion, or is it just incompatible in general with a well-being or post-growth economy? What are your views on that?
Yeah, I love this question because these are exactly the kind of discussions that I think we should be having. And I think in the paper, we still shy away from making any like concrete predictions or suggestions around that. But I think it's safe to say that in a degrowth or post-growth world, investment would look very different regardless. So whether there's something similar to a stock market or not, aspects of it would be very different than today. So what kinds of aspects? Well, first of all, you would have like the governance angle and the like decision-making power are related to organizations that are providing for needs in various contexts. That would probably be different. So shareholders would have, even if they existed, they would have a different sort of power. It's also clear that post-growth businesses wouldn't have this profit maximization motive at all. They'd have a purpose, like broader societal purpose, like delivering food for people in this community, and as such would be considered less investable by today's models, but are still providing a lot of real economy value. Yeah, the stock market question is basically like, would there be some larger organization for trading I guess financial assets or stakes in various projects. And I'm not sure about that, but I think a lot of the activity that we would see would probably be, I mean, maybe more localized, but definitely more like groups of people investing in either something in their community or something elsewhere that they think should be there, whether that's with money or with other forms of capital. And it's unclear if that would translate to having some kind of general mechanism similar to a stock market or not. So
Yeah.
I'd say it's unclear, but it's interesting to think about.
I would answer quickly. So we've had markets for forever. We're going to have markets going forward, but stock markets and human history are relatively new animals. And to go back and think about the pyramid we talked about, where right now financial capital is overweighted. What if fiduciary duty changed to natural capital, human capital, social capital were weighted equally in a fiduciary's responsibility? How would that evolve markets, stock markets? I don't know. That's like asking Darwin, okay, how is this animal going to change in the next 500 years? I don't know. It's going to, because the parameters you put it in, the environment you put it in, is going to change what it is and how it evolves. I imagine, stock markets will shrink in size, financial assets will shrink in size, but what that becomes, I don't know. But we're on the disaster path with that system. Let's design one where those other capitals are part of our fiduciary duty, are the things that we value just as much, if not more. And the model for that is the bioregionalism when I talked about. How would that change things? It would change them drastically, but what that ends up being, I don't have my magic 8 ball to tell me.
Scale.
Thank you, Matt.
It,
But
it's
that's
just
The scale.
very
It's the
sorry,
scale.
Steve. So we're going to keep talking for those who can stay on. I just want to acknowledge that we are at time, and so
Yeah.
some people will have to leave. So I just want to take this opportunity to thank everybody for coming today. So the webinar has been recorded. It will be made available on the Arketa Institute at the website, the YouTube channel. If you're interested in working more with them, please reach out to them as you see fit. And if you want to talk about this more, the role of the stock market, Steve, the importance of scale or the lack thereof, please hang on, stay on the line, because Steve and Anastasia and Matt will stay here. Thank you, everybody, for joining us today.